It's Tuesday, July 1st, 2025, and wow, what a day on Wall Street, huh?
Seriously, the Dow is definitely celebrating, throwing a party almost.
But the Nasdaq looks like it's nursing a bit of a hangover.
Exactly, and you might be sitting there wondering what exactly just unfolded in the markets today.
Yeah, we saw some really unusual yet pretty instructive market action. Definitely sets the stage for quite the deep dive today.
Welcome to the Deep Dive, everyone. This is the show where we really try to unpack the financial world.
Right, turning that complex data into clear insights you can actually use.
Our mission today, give you the ultimate shortcut to understanding the July 1st, 2025 closing bell.
The goal is to spark your trades, sharpen your game plan. That's the idea.
We've sifted through all the market's latest moves, from those surprising index shifts to some pretty compelling individual stock stories.
And we're even peering into what tomorrow holds. Get ready to understand not just what happened, but why it matters deeply to you and your investing strategy.
All right, let's kick off with the macro picture for this Tuesday, July 1st, 2025.
Yeah, because those headline numbers, they immediately tell a story of, well, divergence.
Definitely. The Dow Jones Industrial Average, the DJIA, it closed strong, hit 44,494.94.
That's a significant jump, 400.17 points, a positive 0.91% increase.
Clearly a bank lid bounce, which, we'll unpack that in a bit.
But it was far from a universal rally across the board.
Not at all. The S&P 500, Standard & Poor's 500, pulled back just slightly, closed at 6,198.01.
Down just 6.94 points, so a modest 0.11% decline. Step back just a hair from its Monday record close.
And then the Nasdaq Composite, the tech-heavy one, showed a really clear tech fade.
Yeah, that one closed at 20,202.89, down a more substantial 166.84 points. That's 0.82%.
What's truly intriguing here, I think, is that stark divergence we saw. This isn't your typical market day where, all the major indices move in lockstep, either up together or down together.
Right. Today felt different.
Today, the market experienced a really pronounced rotation. Capital was clearly shifting away from, the high-flying tech sector.
And flowing into more traditional, maybe value-oriented sectors.
Yeah.
Like financials.
Exactly, particularly financials. This hints at these underlying narratives at play, especially after the incredible run we've seen in tech for so long.
So it tells us investors are, actively rebalancing, reacting to different things.
Yeah, reacting to different catalysts, seeking value where they perceive it's emerging, or maybe just taking profits where they've seen huge gains. Makes sense.
Okay, let's dive into some specific assets. Gold, for instance. August futures closed strong today.
Yeah, $3,318 an ounce. That's a solid 0.8% gain.
So what were the immediate drivers? Seems like a few things.
Multifaceted, yeah. We saw some pre-holiday short covering, which you often get, right? Traders closing out shorts before a long weekend to cut risk.
Sure, standard procedure.
But more significantly, there was this renewed safe haven bid for gold. People getting a bit nervous.
Okay. Sparked by what? Tomorrow's data?
Partly anticipation of tomorrow's crucial ADP payroll report that could signal shifts in the labor market, and also a fresh HSBC price upgrade for gold.
Oh, really? What are they projecting?
They're now projecting an average of $3,215 for 2025. So, another bullish voice there.
Zooming out of the bigger picture, then, gold is definitely flexing its safe haven muscles again.
Undeniably. It suggests that despite some indices going up, market participants still have this, degree of underlying nervousness about what's ahead.
Especially with all this economic data coming out.
Right. And the real insight here isn't just that gold's acting as a hedge. It's a subtle but crucial signal. Meaning that institutional money, the quote-unquote smart money, is actively de-risking, even amidst what looks like a buoyant equity market on the surface.
So potential disconnect between headlines and underlying caution.
Precisely. On the bullish side for gold, you've still got ongoing tariff deadline risks fueling uncertainty.
Plus expectations of lower real yields, right? Makes gold more attractive.
Exactly, compared to yielding assets. But from the bearish side, you gotta watch for an overbought RSI, the relative strength index.
Could signal a pullback as traders book profits?
Definitely. Key levels to watch closely. A breakout above $3,345. Or does it find strong support and hold at $3,300?
Those are the battlegrounds. Got it. Okay, let's move over to the digital asset world. Bitcoin.
Yep. Spot price pulled back, hit $106,200, down about 1.1% on the day.
And the primary reason seems to be profit-taking after that record monthly close.
That's what the sources suggest, yeah. Plus, there was a noticeable spillover effect from traditional markets.
You mean the weakness in U.S. tech stocks, like the Nasdaq dip?
Exactly. That contributed to the slump in crypto majors like Bitcoin. It just underscores their increasing correlation, you know?
So this begs the question, is this pullback in Bitcoin a trend break or just a healthy breather?
Experts mostly lean towards the latter, viewing it as a, well, normal, healthy consolidation phase. Unless that critical $5,000 support level gets decisively breached, then maybe it's something more serious.
Okay, so the broader implication is that crypto, despite its own drivers, still reacts to tech sentiment.
It really does. So when big tech sees profit-taking or faces headwinds, the crypto market often feels those ripple effects.
Something crucial to watch if you're in the digital asset space, then, dictates risk appetite.
Absolutely. On the bullish front for Bitcoin, we are still seeing strong interest in ETF inflows. That's supportive.
And there's that historical July seasonality, right? Often favorable.
True. But the bearish case points to long-term holders strategically distributing coins, which can add selling pressure.
Key levels again.
105K remains critical support. A decisive reclaim of 108K would flip the short-term bias back up, signaling renewed confidence.
All right, shifting gears again. Energy market, WTI crude.
August futures closed at $65.11 a barrel, down just 0.5%.
Market's still digesting last week's big move, that 12% war premium flush.
Clearly, a large chunk of that geopolitical risk premium just vanished as tensions eased.
So now traders are focused on what?
Inventories? Keenly focused on the upcoming API and EIA inventory prints. That'll give a clearer picture of U.S. supply levels.
And of course, the ongoing OPEC plus compliance chatter for the next directional move.
Oil is unequivocally in a range-bound period right now, after that swift, dramatic drop.
So the next couple of bucks, up or down, decided by inventory math, basically.
Pretty much. What's fascinating here is how incredibly quickly the market digested those geopolitical premiums. It forced traders right back to supply-demand fundamentals almost overnight.
Any bull case left for oil?
Well, there's potential for a demand burst from July 4th travel with the long holiday weekend coming up in the U.S.
But the bearish factor is still that structural oversupply, right? Around 2 million barrels per day.
That remains the persistent overhang, yes. The key technical level to watch on the chart is $64.
Why $64?
It aligns with the 200-day moving average, often a pretty significant support or resistance point.
Okay, good to know. Finally, let's unpack the U.S. dollar's performance. The DXY.
Right, the dollar index. Closed at 96.66, down about 0.22%.
Still sitting at a 3-year low, driven by those rate cut expectations.
Largely, yeah. Expectations of Fed cuts typically weaken the dollar.
But it paired some deeper losses late in the day.
It did manage to, yeah. After some stronger than expected U.S. jobs data came out.
So that provided a slight counter-narrative to the rate cut story.
A slight but important one. Let's really unpack this dollar situation.
Right.
Dollar weakness has been like the critical component, almost the glue holding the broader reflation trade together across different assets.
Right.
But that late session jobs data, it clearly shows how quickly these narratives can shift on a dime sometimes.
So tomorrow's data volley, with more key reports, will really test this dollar weakness narrative.
It's the ultimate test. The bullish case for the USD would get strong if the upcoming NFP data surprises significantly to the upside. Could spark a sharp bounce.
And the bearish case?
Cemented if the upcoming FOMC minutes hint more explicitly at a July rate cut.
Key level for the DXY.
Watch the 97.00 pivot point. That's where the dollar's trend could either reverse or keep sliding. Market participants are making their bets right there.
Okay, now let's zoom in on what really defined the day, that sector rotation. That was the big story, right?
Undoubtedly. While we saw interesting broad market moves, the real drama was capital flowing between different areas.
So circling back to the Dow's strong performance, absolutely a bankled bounce.
Totally. And this rally was largely fueled by very positive Fed stress test results for the big banks,
which gave them the regulatory green light for
significant share buybacks and increased dividend payments. That sent a wave of excitement through financials investors, naturally.
Here's where it gets really interesting, and this is a crucial insight for you listening. You can almost think of it like Goldman Sachs threw a Wall Street block party today. And all the major banks were invited.
Good analogy.
The positive stress test results gave them and others the regulatory go-ahead to return huge amounts of capital directly to shareholders.
And that just lit a fire under the whole financial sector, drove the Dow way higher.
So it's not just a bank story. It's like a blueprint for how regulatory decisions unlock value.
Exactly. Billions in shareholder value overnight. It forces traders to watch regulatory calendars just as much as earnings calendars now.
Shows the immense power of those regulatory signals on sentiment and performance, sometimes even overshadowing fundamentals.
Goldman Sachs, GS itself, was a standout performer within financials, up a notable 2.5%.
And hit a fresh record high, remarkably.
Just reinforces the direct impact of those stress test wins, directly sparking the buyback and dividend talk we mentioned.
A clear winner on a mixed day really exemplified the sector's momentum.
Goldman's performance vividly highlights this key rotation we're seeing right now in the market.
While tech was pulling back,
Money was demonstrably flowing into what's seen as more traditional value or stability. And the banks, fresh off that good regulatory news, fit the bill perfectly today.
so the insight is that capital seeks the path of least resistance, or the biggest positive catalyst.
It's a classic example. Positive regulatory news can immediately unlock value and attract significant investment, even when other sectors face headwinds.
But while the Dow was celebrating with the banks, the S&P 500 and Nasdaq saw that mild tech fade.
Or big tech rotation, yeah. Even giants like NVIDIA and VDA and Meta logged intraday records earlier.
Before seeing some mild profit-taking by the close.
Which isn't necessarily a dire sign, right? It indicates the underlying AI enthusiasm is still very much intact.
But savvy traders were just cashing in some chips after that incredible long run.
Makes you wonder, though, is the AI golden wave over?
What do you think?
Absolutely not. It's more about smart money taking a healthy, much-needed breather after what's been an incredible, almost parabolic run for some names.
So connecting to the broader market picture, it suggests maybe a more balanced dynamic emerging?
I think so. Rather than just one sector dominating everything, this rotation is actually quite healthy. Prevents overheating, lets other sectors catch up.
Helps diffuse concentration risk rather than signaling panic about AI?
It's a natural ebb and flow, not a fundamental shift away from AI's transformative power.
Okay, but amidst that broader tech fade, Tesla, TSLA, was a definite outlier.
Oh, yeah. Down a significant 4%, made it the day's top headline loser among large caps.
The next biggest loser was Adobe, ADBE, down 1.9%. Tesla's specific driver, though, pretty unique.
Reports surfaced about a Musk-Trump subsidy feud. That put EV names, especially Tesla, in the penalty box.
Shows how that kind of political and regulatory news can have a very direct, very swift impact.
What's truly fascinating here is how much a single high-profile company and even a single news item can ripple through an entire sector, even an index.
Tesla's drop was a primary drag on the Nasdaq today. Pulled down broader tech sentiment.
It vividly illustrates the power of narrative, especially with high-profile figures and regulatory uncertainty.
And a leader like Tesla can become a proxy for broader tech risk.
Especially with those Q2 delivery whispers on the horizon. Traders will be watching that like a hawk for the next catalyst.
All right, let's move on to the specific gainers and losers today, and crucially, why they moved.
Okay, top gainers. Hewlett-Packard Enterprise, HPE, was up a fantastic 11%.
And Juniper Networks, JNPR, followed closely, up 8.5%.
The reason? Big news. A DOJ settlement cleared the path for their $14 billion merger to proceed.
That made them the day's standout gainers. Highlights that regulatory approval impact again.
Beyond those two, we also saw strong performance from Goldman, which we covered, and Caterpillar, CAT.
This is such a classic textbook example of M&A news creating immediate value.
Totally. Two companies locked in a deal, that regulatory hurdle clears, and boom, the market quickly prices in the synergies and future value.
A powerful reminder that fundamental news, like a cleared merger, can lead to explosive moves, often separate from the broader market.
It's about unlocking previously constrained value. Key lesson for any investor.
And on the flip side, as we mentioned, Tesla was the clear outlier loser, significant decline.
Adobe next at 1.9% down, but yeah, no other big names saw such a dip. Underscores Tesla's specific situation.
So while Tesla's drop had its own drama, Adobe's lag is more indicative of that broader tech profit-taking.
I think that's fair. Not necessarily fundamental issues with Adobe itself, more about market participants rebalancing after a strong run.
Looking for value elsewhere or just taking profits off the table?
It's that natural ebb and flow after significant gains. This sector rotation is a key characteristic right now.
So, to encapsulate today's tape, July 1st, 2025, in one sentence.
Go for it.
A bank-powered Dow rally hit a mild tech fade, while rate cut hopes wrestled with tariff jitters and Musk's latest clash with Washington.
That pretty much sums it up. A day of two distinct, sometimes contradictory narratives playing out simultaneously.
So what does this all mean for you, the listener, whether you're an active trader or just an informed investor?
It unequivocally means flexibility is paramount right now, absolutely key.
We've seen capital flows flip between banks and AI chip names for 2 days straight now.
This is emphatically not a market where you can just buy one trend and forget it, expecting it to run forever.
You need to be incredibly nimble, constantly watching for these rotational plays.
And prepared to adapt your strategy as capital actively shifts. The market's demanding active participation and keen observation.
Okay, let's shift focus. Chart check time. And some volatility insights.
Right, looking at the S&P 500 futures.
Right.
They're broadly expected to trade sideways, kind of consolidate.
Until the FOMC minutes tomorrow?
Exactly. The key trading range to watch for the S&P 500 is specifically between 6,150 and 6,240.
That's the zone where the short-term action is likely contained, like a gravitational pull.
Yeah, if you're visualizing the S&P chart, picture that 6,150 to 6,240 range like a boxing ring.
The index is just dancing in the middle, waiting for a catalyst like those minutes to break out either side.
So for traders, this suggests maybe fading the extremes of that range. Buying near 6,150, selling near 6,240.
Unless, of course, volatility really picks up and signals a clear directional breakout.
Right. It's a range-bound trader's market until that catalyst hits.
Speaking of volatility, the VIX, the market's fear gauge, is currently sitting comfortably under 15.
Which is a significant level that options traders especially watch very closely.
So this raises the question, what exactly does VIX under 15 tell us? Why does it matter?
It basically means options are on clearance. Implied volatility, a key part of an option's price, has slid significantly.
Lower implied vol means the market expects less dramatic price swings, making options cheaper.
That's right. For instance, implied vol slid to 32% for NVIDIA after its earnings, meaning deep out of the money calls, while still speculative, were relatively cheap.
But the crucial insight is,
always tread lightly when options are cheap. A consistently low VIX often signals market complacency.
and that's when things can get interesting. Unexpected sharp moves can happen.
Precisely. So while it's an invitation for a tactical play because of the lower cost, approach with caution and understand the risks.
Okay, time for a little market humor break. Because sometimes a meme or a cartoon just nails the sentiment, right?
They really do. We saw one making the rounds today that perfectly captured the day's divergence.
Describe it.
It's a two-panel stock market meme, thin line down the middle. One side says DOW plus 400.
And the other side, attributed to Tesla, just says, hold my beer.
Perfect visual summary of today. While the Dow was surging, Tesla, with its big drop, basically said, hold my beer, and pulled down tech.
Captures the divergence and Tesla's role as a major individual mover perfectly. Quick, witty, gets the point across.
And there was another piece reflecting the ongoing macro debate.
The cartoon.
Yeah, black and white, hand-drawn, bulls and a single bear in a tug-of-war.
Over a rope labeled rate cut.
And the bulls are clearly winning, outnumbering the lone bear.
Clearly illustrating the dominant hope for easing monetary policy from the Fed.
My punchline for that poor bear, somebody give that bear a Red Bull, he's clearly outmuscled.
You know, these visual gags, they're not just for a quick laugh. They perform a function. They perfectly encapsulate the day's dominant narratives that sector split, the persistent rate cut speculation.
Right. They distill complex dynamics into relatable, memorable imagery. Offers a snapshot of the market's collective psychology.
Exactly. What's truly insightful is how humor becomes this barometer for market sentiment.
They show where the collective mind of the market is at, highlighting the key tensions and narratives driving decisions.
It's a fantastic way for you to quickly gauge the emotional temperature, beyond just the raw numbers, into the core of market psychology.
Okay, let's shift our focus now to tomorrow's game plan, July 2nd.
Which is effectively pre-payroll Friday because of the upcoming Independence Day holiday. A lot is front-loaded.
Big day, kicking off at 8:15 a.m. Eastern Time with ADP payrolls.
The closely watched private payrolls peaser before Thursday's crucial NFP report.
A significant miss here could keep those rate cut hopes very much alive, would likely move gold and the dollar.
Then at 10 a.m. ET, factory orders for May. Follow through to today's softer ISM manufacturing print. More insight into manufacturing health.
Yep. And 10:30 a.m. ET, the EIA Weekly Petroleum Status Report. Fresh inventory and demand read after crude's recent slide. Key for energy stocks.
What's the number to watch there?
A draw greater than 3 million barrels could blunt the bear case for oil, potentially squeeze WTI towards $67 a barrel.
But the biggest macro catalyst of the day
Comes at 2 p.m. ET, the release of the FOMC minutes from the June meeting.
Any hint in there of a serious July cut debate among Fed officials could really jolt things.
Especially the front end of the yield curve and potentially tech multiples given their rate sensitivity.
And no Fed speaker scheduled tomorrow puts extra focus squarely on these minutes, right? Primary source for Fed thinking.
Exactly. Also, throughout the day, keep an ear out for Tesla delivery whispers.
After today's drop, a low enough bar beat could spark a relief pop, potentially bleed into crypto sentiment.
Could happen, given their correlation. And finally, around 8 a.m. ET, OPEC launches its 2025 annual statistical bulletin from Vienna.
That often includes fresh demand and supply tables that can move crude and oil-linked currencies. Watch headlines there.
Okay, so this begs the important question. How do you actually prepare for a day packed with so many potential market-moving catalysts?
You absolutely need a clear, actionable game plan, which we're about to lay out.
With these event-driven days, it's not just knowing the news, it's anticipating reactions and having your levels ready. Agility is crucial.
In terms of corporate earnings, no mega cap tech or banks tomorrow. Earnings season ramps up after July 10th.
But still a couple to watch for sector insights. Constellation Brands, STZ, reports before market open, call it 10.30 ET.
What to watch there? Beer margins versus tequila drag. Buyback guidance.
Precisely. Also, UniFirst, UNF, reports pre-market. Watch their wage inflation pass-through. Can they pass costs on?
And their rental uniform volumes as a bellwether for business activity.
Okay, now for some specific tactical setups for traders navigating tomorrow.
First, consider fading opening gaps. Thin holiday volume, headline swings. Invites mean reversion scalps.
Meaning prices tend to revert back towards average after strong initial moves. Second, keep a very close eye on that sector rotation.
Banks like Goldman, JP Morgan versus AI chips like NVIDIA, AMD. Flows flip 2 days straight. Could continue.
Third, for an event hedge, maybe short-dated straddles on QQQ, the Nasdaq 100 ETF.
Especially if implied vol dips below 15% into the FOMC minutes. Lets you play a big move either way.
Fourth, watch the DXY, the dollar index, for a potential pause in its drift, 9-day losing streak.
My pause if ADP surprises to the upside. So if you're long euro, maybe keep a tight stop below 1.1750.
Good risk management. And here are some asset-specific tactical levels for tomorrow. S&P futures, fade extremes of 6,150, 6,240, unless VIX 15.
USD DXY. Soft tone unless ADP plus 200K. Watch that 96.90 pivot.
Gold remains bid on any data miss, stops below $3,300, breakout above $3,345, $3,380.
WTI crude. Bullish flip if inventory draw 3 million barrels. Watch $64 floor, $67 cap.
And Bitcoin, correlated to tech vol, dovish minutes could reclaim 108K, keep 105K stop.
This is your absolute cheat sheet for navigating tomorrow. Actionable levels, specific strategies.
And remember, the market closes early Thursday, 1 p.m. ET for Independence Day. Friday's a full holiday.
So tomorrow, July 2nd, is effectively your pre-payroll Friday before a long weekend.
Stay incredibly nimble, because the fireworks could definitely start before the real fireworks on July 4th.
All right, now for our bold but reasonable predictions to wrap things up.
Let's hear them.
I'll stake my claim first. I predict the S&P closes Wednesday above 6,220 if ADP payrolls come in below 180,000.
Okay, so why is ADP below 180K so pivotal for the S&P in your view?
Because it strongly reinforces that rate cut narrative, right? Which has been a huge tailwind for equities.
So a cooling labor market gives the Fed more room to ease, which is what the market wants.
Exactly. And what's fascinating is how quickly the market reacts to these early indicators. They inform the bigger picture.
It's like an early warning system. Okay, my turn.
Go for it.
I'll counter with this. Bitcoin reclaims $108,000 on dovish FOMC minutes tomorrow.
Tying it to the minutes. Why that connection?
It directly connects to that tech volatility correlation we discussed. If the FOMC minutes are dovish, hinting at a July cut.
That generally boosts risk assets, including tech.
And Bitcoin often follows that lead. Reclaiming 108K would flip the short-term bias back up, signaling renewed confidence after today's profit-taking.
Shows how macro catalysts ripple far beyond traditional stocks into digital assets too. Critical relationship.
So looking at these predictions, what stands out?
They really highlight the two biggest drivers right now. The Fed's next move on rates and the market's overall appetite for risk, especially in tech and crypto.
These aren't just random numbers. They represent the powerful narratives shaping market moves faster than anything else. Understanding them is key.
Okay, and finally, before we wrap, a special segment. Let's acknowledge today, July 1st, 2025, is Canada Day.
That's right. Important national statutory holiday for our neighbors up north. Happy Canada Day.
Celebrating Canada's birthday, 158 years ago, July 1st, 1867. Became a federation, signed the Constitution Act.
Typically means many businesses are closed. And since it's a Tuesday, many probably took Monday off for a 4-day weekend.
Which can subtly impact market activity, trading volumes here in North America.
It's fascinating, right? How a national holiday, seemingly separate from the market grind, can impact volumes or dynamics.
A good reminder that not everything moving markets is a number on a screen. Human behavior, holidays, traditions play a role.
Absolutely. Now, a big tradition for Canada Day has been fireworks. Huge displays.
But there's been a growing trend of cancellations by municipalities recently.
Yeah, like the Port of Vancouver permanently canceled theirs in 2023, citing high costs. Others followed.
Reasons cited range from cost, fire hazards, impact on pets and wildlife, even smoke and pollution concerns.
It raises that broader question. What happens when cherished traditions clash with evolving societal concerns?
It's not just about the show, but the environmental impact, animal well-being, how public funds are used.
A dynamic social shift reflecting broader priorities, moving beyond just celebration to more thoughtful consideration of impact.
And an interesting new direction is emerging from this.
What's that?
Some municipalities are redirecting savings from canceled fireworks to add events focused on First Nations collaboration.
Oh, that's significant.
Specifically, the Vancouver Port Authority renamed their event from Canada Day to Canada Together.
Wow.
Celebrations planned collaboratively with representatives from the Musqueam, Squamish, and Tsleil-Waututh nations, under the theme, Weaving Together the Fabric of a Nation.
This is where it gets truly interesting. It's not just canceling something, it's reimagining celebration, acknowledging deeper historical contexts.
A move towards weaving together the fabric of a nation with First Nations collaboration shows a profound shift.
It's an aha moment for understanding evolving national narratives, steps towards reconciliation, a more inclusive future, highlights the growing importance of corporate social responsibility too.
And finally, to bring it back to the human element, connecting to the market. There was a comment from Francis's in one of the sources.
What did Francis say?
Mentioned not getting Canada Day Monday off this year. Worried about companies trimming cost fringes impacting vacation, wages, even basic supplies like pens.
Oof. That's a very real concern for many people, especially when companies look to cut costs.
So what does this mean for you, the individual navigating today's economy?
It's a subtle but really important connection. While we talk markets and macro, company-level decisions on holidays, benefits, supplies, they trickle down.
Highlights how even small changes driven by cost saving impact people's security, work-life balance, well-being.
A crucial reminder that market shifts and corporate strategies have real-world human implications, way beyond consumer.
And that, everyone, wraps up our deep dive into the July 1st, 2025 closing bell.
We've fused the facts from the sources you provided, hopefully sparked some actionable insights for your trades. That's the goal.
And remember to check out the Theta Fuse newsletter for even more in-depth analysis and market insights.
Don't forget, tomorrow, July 2nd, is packed with catalysts. Thursday, July 3rd, is that early half-day close before the Independence Day holiday Friday.
Stay nimble, stay informed.
And as always, please remember, the information shared here is for educational purposes only. It is definitely not financial advice.
Please do your own research and consult with a qualified financial professional before making any investment decisions.
If you found this deep dive helpful, valuable,
please smash that like button, subscribe to the channel, and ring the bell so the algorithm loves you back and you never miss an update.
We genuinely appreciate you joining us for this deep dive.
Thanks for tuning in. Trade well.
And we'll see you in the next deep dive.